Many new traders start trading patterns because they're told that the patterns work. What they fail to realize is the reason for the pattern working. Understanding why you're trading a pattern is important because it will give you more confidence in reasoning for the trade. The head and shoulders is a very simple pattern. It consists of the left shoulder, head, right shoulder, and neckline. An inverse head and shoulders has the same characteristics, but the pattern is reversed. We'll go over a few different examples. For this head and shoulders, the left and right shoulder are level, and the neckline is tilted upward. Here, the right shoulder is lower than the left shoulder, and the neckline is tilted downward. Now we see an inverse head and shoulders. The right shoulder is below the left shoulder, and the neckline is tilted downward. Lastly, another inverse head and shoulders. This time, the neckline is tilted upwards, and the right shoulder is slightly higher than the left shoulder. These are 4 examples of a vast number of ways that the head and shoulders can form. Traders may have different rules about which head and shoulders patterns are proper and which aren't. However, the reason for the pattern working remains the same. The pattern represents a shift in momentum from bullish to bearish or from bearish to bullish. An uptrend is defined as a series of higher highs and higher lows. Once a lower high and lower low are made, it indicates that the momentum has begun to shift. A head and shoulders pattern has now formed. A break of the neckline suggests that the bullish momentum has gone and the bears have begun to take over. The same is true for an inverse head and shoulders pattern. Traders see this pattern as an opportunity to enter a trade based on a shift in market momentum. Keep in mind, these patterns don't work 100% of the time, and it is recommended that you use them as part of a tested strategy with other confluences.